Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/markets plus for more episodes.
In this episode from BMO Equity Research's Metal Matters, BMO Commodities Analyst Helen Amos is joined by Joel Jackson, Equity Research Analyst, Fertilizers and Chemicals, BMO Capital Markets, to discuss disruptions to fertilizer supply chains stemming from the Iran conflict and what this means for mining operations.
Welcome back, everyone. It's been a few weeks since the last Metal Matters podcast. A lot has obviously been going on with the Iran conflict. It's in the foreground of all of the markets right now, even more so for commodities. We published our combined commodity impact webinar on the Middle East via Metal Matters a couple of weeks ago. Hope you've seen that. And also just this week, we've published our new commodity prices deck and equity view as well. In there, we've made some really big changes to our commodity order of preferences for the next few months. We've raised up aluminium, thermal coal, also raised up iron ore and zinc, pushed down in terms of order of preferences just for the next few quarters because we think that's a lot of exposure to macro headwinds, pushed down actually the price view for copper and gold. We do think they're going to get back to the previous record levels, but I think it's going to take a while for that same level of risk appetite that we saw in early 2026 to return. So today, we're going to talk about fertilizers and how that impacts the world of metals and mining. I'm lucky enough to be joined by Joel Jackson. Joel Jackson, as many of you might know, he's an MD here in BMO Equity Research. He's been with BMO for 20 years. He leads our coverage on the chemicals, fertilizer, and agriculture equipment sectors. Joel's received a lot of top awards over the years. In 2024, 2025, Joel was top 3 ranking in Excel surveys and also received ranking as a Top Gun analyst in agriculture in the Brendan Woods International Survey. Joel has a background in engineering. Joel, thanks very much for joining us today.
Helen, thanks for having me.
Okay, so a lot to talk about. Fertilizers has definitely been in the headlines. We see some really big price news. I think I saw a headline yesterday that sulphur prices were at an 18-year high. And, I care about it from the metals and mining perspective for 2 reasons. One is that some of those fertilizers feed directly into the mining process. So sulphur, so sulphuric acid into SXEW production, and then ammonia nitrate in terms of explosives. But also I care about it from a macro impact. So fertilizers in the food chain, how that impacts the wealth effect, particularly in emerging markets. So I want to dig into this further with you today, Joel. So let's start at the beginning. So in our webinar a couple of weeks ago, we showed a chart showing the Middle Eastern supply dependency by commodity. And your commodities dwarfed everything else on that chart by a long way. So a lot of them have massive exposure to exports via the Strait of Hormuz. So maybe you can start by just recapping on the basics. What is the supply exposure and what have we seen in terms of price impact so far?
Right, Helen, absolutely. So certainly there's a lot of nitrogen fertilizers coming out of the Middle East, as well as sulfur and methanol. Phosphate and potash are not as impacted, but definitely when you think of the Middle East and you think of the countries around Iran, you think of 40, 45, 50% of, nitrogen exports are coming out of those countries. When you pile in also Egypt, which is getting gas, and countries like Israel. And so there's a lot of impacts on nitrogen, especially. It's why nitrogen prices are up 30, 40, 50, 60%, depending on the product in the last several weeks. You also, when you have phosphate fertilizer, it's using sulfur and ammonia. Ammonia is a form of nitrogen. And so you got phosphate prices also up, not as much as nitrogen, but they're, passing through some of these higher nitrogen costs, ammonia costs. And then sulfur, the Middle East and countries around Iran including Iran, are solid provider of sulfur. You're talking 40, 50, 45%, of sulfur's exports are also coming out of the Middle East and out of the Gulf. And so you really have seen, sulfur prices, which were already high to start the year, are likely going to rise again when when April and Q2 contract prices reset. We've seen spot prices up in China for sulfur a fair bit, and it's a big problem when you add in the fact that Russia and Ukraine are large suppliers of nitrogen too, and we've seen drone attacks from Ukraine targeting Russian plants. It just piles up the problems. In the broader Middle East, Egypt is a large supplier of nitrogen too. It's getting gas from Israel, and some of that gas has been cut off the last month or so. When you think about India being a large producer of nitrogen as well, I mean, it's getting half of the gas or so for its nitrogen production from Qatar. And most of us on this podcast will know that Qatar gas fields have been impacted, and there's a lot of problems with gas getting out of Qatar right now. So, I mean, there's this massive impacts on fertilizer, especially nitrogen, sulfur, and then secondary impacts on phosphate as well.
What could happen? I mean, if the conflict ramps off very soon in the next few days, would that mean that everything just slams back down, or is there a lasting impact on the fertilizers markets? Is it going to take some time to disentangle and for everything to go back to normal?
Definitely it'll take some time to disentangle. I think if the conflict ends in the next few days, you'll start to see some more normalization. There's obviously been some damage to some assets around the Middle East, but you'll start to see some normalization. We would imagine what happened in 2022, in the months, at the beginning of the Russia-Ukraine conflict, might be the same that happens here, which is commodity prices like nitrogen prices and other fertilizer prices kind of walk down back to early 22 Russia-Ukraine war levels. They walk down over about a year. So we would expect it would take about a year for prices to come back down. Now we haven't heard of too much lasting damage of nitrogen assets, but in the Middle East, but it's hard to know what damage has happened to some of the gas fields around the Middle East. But yes, we would imagine, as probably a base case, assume it takes about a year for prices to walk back down, like happened in 2022.
Yeah. And I guess already inventory in the system is drawing down. That's going to take some while to replenish. What about other parts of the system? Are we seeing supply from elsewhere reacting, either on the nitrogen side or the sulfur side? What slack in the system is there to plug the gap? And we'll come on to the mining impacts in a little while. And then what about prices? Prices have already done a lot of moves. Is that starting to bring about any sort of demand destruction, or bringing out any supply reaction itself?
So we haven't really seen production come online. What's happening also in the nitrogen world is this is the part of the year where China typically restricts exports. China's a bit long for nitrogen, a little bit, and they have not agreed to let exports flow much anymore. It's probably going to come back on after the spring, maybe by May, but they haven't agreed to expedite that. In fact, we've seen more problems around the world. Like I talked about, because gas being poor, we've seen Algeria, which has a lot of nitrogen production, actually cut gas allocations to nitrogen plants because they'd rather use the gas and sell the gas than use the gas for nitrogen upgrading to nitrogen. In Australia, we've seen some unrelated problems on some ammonia plants there that's cut ammonia production in Australia at a Yarra facility for maybe a month and a half. So, there's not a lot of idle nitrogen capacity sitting on the sidelines. Maybe China could turn the taps back on more, but hasn't seemed to want to do that yet. Sulfur, we haven't really seen any new capacity or new coming on or ramping back on. There's been a lot of tightness in sulfur going on for a number of quarters, as you know. And so, demand destruction, that's what probably has to happen in order to balance all this. You could say, a sophisticated farmer is not going to apply less nitrogen on an acre of corn. They're going to apply, let's say, 200 pounds an acre. Maybe they'll go to 190, but that's risky when you really want to focus on yield. But what you might do is you might switch your acres from more nitrogen intensive crops like corn to something like soybeans, which doesn't need external nitrogen. And you might see some of that switching for some of the last acres in the US to spring or maybe even South America.
Yeah, sure. So it sounds like, in a way, the opposite of a supply reaction, like in a more supply of some of these fertilizers has been taken off as a result of this tightness in the gas market. And I guess impossible to really know what the inventory situation is, but what sort of inventory cover do various different countries typically have for the different fertilizer products?
So the war here started at a very interesting time, like late February, which is right at the beginning of the key farmer procurement period for fertilizer in the US and in Europe ahead of spring planting. So you would think by the end of February, when this war started, the channel was full of inventory of fertilizer. Remember, many farmers do apply some of the fertilizer in the fall. So some of the fertilizer already goes down in the fall, and they're buying their extra tons of fertilizer March, April. They're planting April, May, and, generally speaking. And a lot of the product that's purchased March, April, May, was prepaid already. So you could argue that a lot of the fertilizer is already forward deployed. There weren't really shortages. And so, I don't think there's inventory problems now in potash, which we haven't talked about on this session so far, because potash really hasn't been impacted by this war. Yes, there's about 6 to 7 million tons of potash capacity in Israel and Jordan, but they're able to export their tons through the Mediterranean or up the Red Sea, where those countries are, obviously. Potash inventories end of February were low in Brazil and low in China. Prices of potash have been up slightly, but that was not about the war. That was just demand's been very strong. Supply has been difficult in China. Some of the producers have been having trouble producing. So the only shortages I've really seen have been in potash. Prices are only up slightly again, and that's unrelated to this war.
Yeah, interesting. And interesting as well, the seasonality of it all as well, which adds this additional layer of complexity. Okay, well, look, that was super useful for framing the situation of fertilizer. So I'm going to talk and connect this briefly to mining. So why do we care about this in my world? Well, sulphuric acid, and hence sulphur, is a really important input into the leach SXEW process, which we see being used in particularly copper. So, any shortage that emerges in sulphur or any big price response has implications for production costs along the mining cost curve. But also potentially, if a scarcity situation does emerge in the future, that could, I guess, also lead to potential volume impact. So look, we were trying to dig around some data before this podcast, and there's lots of different statistics out there. There's no one version of the truth, but it seems like metals and mining accounts for somewhere in the region of 15 or 20%, depending on the source that you look at, of global sulphur consumption. So the bulk of it is in fertilizers. And of that, it looks like copper is the biggest chunk. And then you also have nickel after that, and then gold, and then the other base metals and uranium. So just to put some numbers around it, if we take copper, for example, so the leach SXEW process, that accounts for about 16% of global copper mine supply. And actually a big chunk of that is from the SXEW operations in the DRC. So that's about 6% alone of global mine output. And then also SXEW operations in Chile, and that's another 5%. And then after that, we have the US SXEW, that's about 2%. Now, across the total population of SXEW operations, sulphuric acid accounts for, on average, about 17% of average C1 costs. And that's according to WoodMac data. It obviously varies a lot by region. But what we find is that, and this has been coming up a lot with investors over the last few weeks, it's the DRC that has the most vulnerability to Middle Eastern sulphur supply disruptions, because the DRC is a major importer of sulphur anyway. They have very limited local supplies, unlike in Chile and the US. And also 90% or thereabouts of DRC's sulphur imports come from the Middle East, so exported via the Strait of Hormuz. So there's sensitivity there to both price changes and the impact that has, depending on how the conflict evolves, potentially concerns around volume impact as well. So I would say that's where investors' focus has really been. Now, so copper, SXEW, that's a major consumer of sulphur. We think maybe it's around 5 million tons per year of sulphur consumption going into that process. And then as well as that, nickel, that's important as well. So you've got HPAL nickel production in Indonesia. That is also alone a major consumer of sulphur. So sulphuric acid costs might account for maybe 40 to 50% of HPAL costs. And also Indonesia, as a result, is a huge importer of sulphur. It's actually the world's fourth largest importer of sulphur after China, Morocco, and DRC. So, we've been getting a lot of questions around that, both in terms of cost impact, but also could it take supply out. We're not hearing of any evidence yet that it's resulting in any volume loss of copper or nickel. And of course, it's really difficult to say how much inventory mines are working with. Some might have very low storage capacity, so they might be on a more hand-to-mouth basis. Others might have, 2 to 3 months of sulphur stock on hand. And then also, maybe some contingency purchases have already started. So thinking about the big picture then for sulphur and then how that moves into mining, if we did say, Joel, move into a situation of physical scarcity of sulphur, and we look back at historical examples of where the market has tightened, how has that sulphur been rationed? I mean, I'm assuming that it gets preserved for the fertilizer and food value chain that wins out, and then other sectors would get rationed. But have you got any examples of how it might have played out previously?
Well, I think what happens in China, which is a big importer of sulfur, is we've seen them ratchet down their demand for it. So they're curtailing phosphate production. That's what they're doing. They're buying less sulfur. It comes a China import response. As I think about sulfur and fertilizer, let's say U.S. produces a phosphate, which are, like a Mosaic, which buys a lot of sulfur. It's got a U.S. supply of sulfur. So it may end up paying whatever price it's going to pay for sulfur coming up here, and maybe a lot more, but I know it will get it. Whereas global producers, let's say like in Morocco, which are large phosphate producers, and they buy a lot of sulfur from the Middle East, they may not be able to get sulfur supply, and they may have to ratchet down their production, by a third or a quarter or 10%, whatever, to because of the sulfur supply problem. But I think it's going to be China-led, that Chinese phosphate production would have to lower and lower their import demand for sulfur. But we would also see that spread to, imagine, in a dire situation, other large fertilizer buyers of sulfur, such as OCP in Morocco.
Yeah. So it sounds like case by case, but perhaps what you're saying is China as the marginal buyer might have to cut back. And to what extent, I guess, silly question maybe, but can there be like a substitutability between the different fertilizer products? So if there isn't enough sulfur, you could switch to something else. Does that play out in real time? Or is that quite slow moving?
Not really. What you could see is some of the specialty fertilizers have problems. Like, you can't really substitute potash, nitrate, and phosphate. You would, like I said earlier, you would just sort of switch to crops that might use less pounds per acre of a certain nutrient. But you might see the specialties, like in China, there's a lot of SOP, potassium sulfate fertilizer, made through a process called the Mannheim process, where you react sulfuric acid with potash. And maybe that specialty product doesn't happen because you need to ration the sulfur for other applications. So maybe you end up seeing, again, the specialties go down.
But the other point I wanted to make, when we were getting investor questions on this the last few weeks about impact on copper particularly, is that, we can't forget that sulphuric acid, that's a major byproduct of copper smelting. So you've got, the 16% of the cost curve, supply curve, SXEW process that goes straight to cathode. But then the other 84%, that's from, your conventional concentrate mill smelting refining route, right? So, and sulphuric acid, as you say, sulfur prices have been rising for some time now, even before the conflict. Sulphuric acid has become like a really important byproduct revenue for the smelters, particularly in China. And that's one of the reasons why they've been able to survive with very low and negative TCRCs. So actually, for a big chunk of the copper mine cost curve, because we bring it all the way through to the cost through to refined, the sulphuric acid price actually acts as a negative cost. So yeah, linking it back, going back to, from mining to fertilizer again, another connection between our worlds is explosives. So explosives, major input into the mining process, not necessarily a major cost, but definitely a vital input into mining. So ammonia nitrate, that seems like quite an opaque part of the market. I think a lot of it is used in fertilizers, but there's a good segment of it that's used for mining. Can you give us a little bit of a 101, maybe, Joel, on ammonia nitrate, help us understand the flows, what is the exposure to Middle East, and then we can unpack that there.
I mean, there's indirectly impacts here, right? So Russia is the largest supplier of ammonium nitrate, And then you've got Brazil and other countries that are the largest importers. Not a lot of Middle East countries show up there because ammonium nitrate is not something you want to ship around the world a lot. I mean, there's two types of ammonium nitrate in general terms. There's fertilizer grade and explosives grade. And a lot of countries don't let fertilizer grade AN or ammonium nitrate get applied because of the dangers. But what is a lot of ammonia does get upgraded to ammonium nitrate. And so as ammonia prices are obviously going up in this conflict, so will ammonium nitrate prices. And so that would raise the cost to explosives companies and miners. But yeah, it's not a lot direct impact. It's more about nitrogen prices going up that lead AN prices to go up as well.
Yeah, so it sounds like much less exposed or much lower potential for there to be like a supply shortage or a physical constraint because of the lower dependency to the Middle East. Is that right?
Yeah, maybe that's probably right. A prolonged conflict, if we've got nitrogen shortages, then I imagine it does have to spread downstream to the AN world. But if we're just, days or a couple weeks away, then maybe it's not a problem. But yeah, as this prolongs, I can't see why this downstream market wouldn't also be impacted.
The other topic I wanted us to address is on the macro. So you've got fertilizers transmitting through to food, that transmits through to buying power and the wealth effect in many parts of the world, inflation, of course. But it seems like the fertilizer price moves aren't yet transmitting through to food prices. Yeah, is that right, Joel?
Yes, we're recording this on March 25th, right? 3.5 weeks into this conflict. And crop prices have barely moved up. They may be up slightly in the last 3.5 weeks. So definitely are not seeing an impact on food prices right now. How this could play out over time, though, would be if input costs are higher for farmers, energy prices, fertilizer prices, as you get into kind of the South American, main season this summer, fall, and then another season, 27 season for the U.S. farmer. And if they've got to pay higher costs and they're not getting better crop prices, then I imagine you're going to have to see food inflation. Those crop prices are going to have to move with the higher inflation. I mean, unless we're talking about more U.S. government bailouts, right? We know that the Trump administration paid out about $12 billion of subsidies to farmers in February of 26. Yeah. There's stories that they might do more subsidies as part of some more military spending. So if we do get more subsidies in the U.S. government, maybe that will make not crop price not have to rise. But I would imagine as we get into 2027, you'd have to see crop and food prices rise to offset these higher costs, but we just haven't seen it yet.
Yeah, and also, the impact again on dwindling inventory as well. So often there's a lag in the system, I guess. And to what extent did we see that delayed transmission effect? If we cast our minds back to 2022, Russia's invasion of Ukraine, can you remind us how things played out there when, big moves on the fertilizer side? How long does it take to transmit through to food prices and maybe even shortages as well?
So that conflict in 2022, the beginning of that conflict was totally different than this, because we can think of Russia and Ukraine as being large agricultural, producers, right? Ukraine, Russia, these are corn, wheat, large producers, whereas so grain prices were impacted. Then corn prices went into the sixes per bushel, whereas corn is staying now here $4.50 to $5 a bushel. So crop prices much higher that war, because there were real concerns that Ukraine would not be able to produce crops and other impacts. Their grain embargoes, Russia wasn't letting your grain embargoes get out of the Black Sea. Whereas here in the Middle East, obviously, these are not bread baskets, not growing a lot of grains for obvious reasons. I'll make a joke, in the desert, you're not really growing a lot of grains, right? So it's a different conflict. So we just haven't seen crop prices rise. So I can't use 2022 as a good analogy.
No, that's fair. I mean, maybe it's a better analogy for the oil and gas side, the energy side. A lot of analysts, investors have been looking back at that period of time and thinking about what happened to metal prices over that time, the dollar, inflation, and so on. Look, that was super helpful. Before we sign off, Joel, I thought, maybe I would give you the opportunity. You've been having loads of conversations with investors since the conflict started. What are the things that you think are not being talked about enough? What do you think the market or consensus is missing in your space?
Yeah, I think it's that people are so obsessed with the duration of the war, which is correct, right? Everyone's just obsessed with it's going to end in tomorrow or in 24 hours or 3 weeks. And obviously the conversation 3 weeks ago was, it's going to end tomorrow, and now could be weeks or months. I think that investors are also very concerned with the question of what this means for farmers. So it's, are they going to plant their acres based on a shortage of fertilizer availability? But we talked about earlier in this session, no, we don't think fertilizer is short right now. So this is going to be more of a 2027 question. So I think investors maybe aren't realizing that a lot of the impacts from an ag world will be seen more in late 26 and 27 than immediate.
Maybe, I can share some things from my world. I mean, I think there's maybe still a sense that things will snap back quite soon. And, heading into this conflict, we had been riding on a high, metals and mining. So the 6 months leading into this, we'd seen lots of new money flowing into our space, be that into metal ETFs like gold, silver, into commodity futures. Positioning was pretty long, or new money coming into equities, basically generalists coming into the space. And I think that's partly why we have been quite badly impacted, our space, since this up, because we've had a lot of that new money reversing back out. And I think obviously same with me, a lot of people are heavily focused on duration. For me, still, it's emerging markets. I still don't think enough people are thinking about the impact that sustained higher energy prices can have on their growth trajectory. And I think we all forgot how much of a tailwind weak or low oil prices, low gas prices, and also weak dollar has been for emerging market development. We were seeing some really good positive momentum in India, for example, also ASEAN in the last few years. But we forgot that a lot of that was assisted by the macro and low energy prices. And we've seen the reaction now. A lot of these big oil importing countries have suffered a lot of weakness in their currencies, which is only causing more pain in terms of their ability to pay for imports, be that goods or direct commodities. And heading into last year, Brent crude was averaging like $68 a barrel. So even if we settled at something like 80 or 90, that's still a huge increase year on year. So I think I'm with you, it's that duration. It's how long is this impact, and the demand side is kind of an unknown, because you've also got new things layered on that we didn't have a few years ago, i.e. an accelerated pace of electrification, AI, how much of that CapEx is going to be deployed anyway, regardless of the macro. And then obviously defense as a new overlay. So not straightforward, but I would say emerging market demand. And that applies for industrial metals as much as it applies for precious metals. Okay, Joel, I think that brings us to the end of Metal Matters this week. I would like to say a big thank you for giving up your time to join and teaching us a little bit about your world. And we look forward to continue the discussion at another point in the future.
Thanks, Helen.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.